Hello, everybody. Thank you so much for joining me. Good evening. My name is Brian Feroldi. Thank you guys so much for taking the time to log in and watch this webinar. The goal here is to educate everybody that's watching this about what the stock market is, how it works, and why it is, I believe, the greatest wealth creation machine of all time. So thank you so much for showing up. So for those that don't know me, my name is Brian Feroldi. I have been investing in the stock market for 20 years, and now I am a financial educator. Most people know me from social media across all my platforms. I've got about 1 million followers or so. I'm also the author of this book here, which is called Why Does the Stock Market Going Up? But I absolutely love teaching investors about what the stock market is, how it works, and how they can use it to build wealth. So this webinar is going to be roughly 50 minutes or so. And then afterwards, we're going to move right into any questions and answers that you have. So please, use the Q&A function to ask any questions that you have. I really want to make sure that we answer any questions that you guys have about what the stock market is and how it works. For example, one question you might have is, why do you have a mark on your face? That's kind of weird. Well, I actually hit myself in the face with my leaf blower about 3 hours ago. I was trying to change something else and popped myself right in the face. So that's one question out of the way. Here is the agenda for the rest of the webinar. We're going to talk about why you should care about the stock market, what it is, why stocks are worth anything, why the stock market goes up, and how to invest. So let's just jump right into it with this question, which I think is an important one. Why should anybody care about the stock market? To me, when I was younger, the stock market just seemed like a random number generator. Some days up, some days down. Who cares? Really hard to care about the stock market. So to tell you why you should care about it, I want to introduce you to a fictional friend of mine. His name is Aaron. Now, Aaron was a typical worker in the United States, and in 1981, Aaron got his first job. Now, Aaron was making $2,600 US per year. And Aaron decided Aaron was not good with money. Aaron lived paycheck to paycheck. So money came in and money immediately left his account. So he lived off of his salary. Wasn't great with money. However, Aaron made one good financial decision in his life. When Aaron got a job, he signed up for this thing we have in the United States called a 401k. Now, a 401k is a tax advantage plan that lets people put money into the U.S. stock market. So Aaron didn't know what this thing was, but he decided to contribute $40 a month to his 401k and invest it in the stock market. Now, Aaron knew nothing about stocks. When his statements would come in the mail, he would just throw them away. He didn't understand them at all. Now, Aaron had a long and prosperous career, and 40 years later, it was time for Aaron to retire. So it was 2020, and Aaron was ready finally to take a look at his 401k, this thing that he'd been investing in for 40 years. And how much money do you think was in Aaron's 401k? Investing for 40 years, $40 US per month. The answer is $301,000. $301,000. That's how much money Aaron's 401k had grown to. Now, if you're good at math, you might be thinking $40 a month times 12 months in a year times 40 years. This is how much Aaron put in to the stock market. That's $19,000 $200. How the heck did $19,000 turn into $300,000? The answer is the U.S. stock market, the magic, the miracle of the U.S. stock market. So here is a graph that shows how much money Aaron was contributing in total to the stock market. $19,200 over this 40-year period. But the red line here shows the value of Aaron's portfolio capping out at $300,000. $300,000. Now, perhaps you're wondering if I cherry-picked this data, right? 1981 to 2020, was that just like an unusually good 40-year period for the U.S. stock market? Well, believe it or not, the answer is no. No. If you look back at the 220-year returns of the U.S. stock market, this U.S. stock market has returned 6.9% annualized in real terms. Real terms means after subtracting inflation. So the returns of the stock market before inflation were about 10%. Inflation in the United States has been about 3%. That gets us to that 7%. And that return has been going on for over 220 years. This graph actually shows $1 invested in the stock market in 1801. $1, a single dollar, was worth $2.3 million 220 years later. And that return, the return of stocks, blows away bonds, bills, gold, and the US dollar. So the stock market has been the wealth creation machine for over 220 years. That is why everybody listening to this should care about it. The stock market enables ordinary people with ordinary means to become extraordinarily wealthy. Okay, so that's why you should care about it. Let's talk about, well, what is the stock market? What do those words even mean? You may have heard the stock market get quoted in the paper, or you may have heard somebody say it before, but let's actually dive into the definition of what these words even mean. Now, let's start with the word stock. What does the word stock mean? Stock simply means a owner's permanent legal claim, an owner's permanent legal claim on a portion of a company's assets and future profits. That's what a stock is. A stock represents a permanent legal claim on a portion of a company's assets and profits. If you're familiar with housing, how do we figure out who owns a house or who owns real estate? Well, the answer there, in the United States at least, is a deed. A deed is a piece of paper that says this person owns this house. That same concept applies to corporations or companies. A stock is a piece of paper that says this person has a legal claim on this corporation. So deed as to house, as stock is to company. Now let's take Apple. Apple as an example. Apple is a corporation, a big public company. And Apple just so happens to have 15.8 billion shares of stock outstanding, meaning Apple, the entire company, everything that Apple owns is divided into 15.8 billion slices. Now, Apple is a publicly traded company. That means that anybody in the world can become a part shareholder of Apple, the company. Those 15.8 billion shares are owned by the general public. Now, how does a company figure out how many shares it should have? Well, in Apple's case, it chose 15.8 billion. But a company can choose as many shares as it wants. For example, Microsoft, another publicly traded company, Microsoft has 7.5 billion shares outstanding. Uber, another publicly traded company, has 1.7 billion shares outstanding. The number of shares doesn't matter. Think of shares like slices of a piece of cake. How many slices can there be of a cake? Well, it depends on how sharp your knife is. You can have lots of slices. So that's all this means. This means how many slices are there of these companies for ownership. So that's all a stock is. A stock represents fractional ownership of a corporation. All right? So how about that second word? Market. What does the word market means? Well, the stock market is a collection of exchanges where shares of publicly traded companies are issued, bought, and sold. That's what a stock market is. Now, if that sounds a little confusing, think of it like this. What's a farmer's market? A farmer's market is a place where food buyers go and buy from food sellers. That's what a farmer's market is. So the stock market is the same thing, except for instead of there being food buyers, we call those people investors. Investors are looking to buy stock. And instead of food sellers, those are the companies that have the stock, and the stock market, investors and companies exchange or trade with each other shares of companies. So farmer market is to food what stock market is to stocks. Now, in the United States, there are two of the largest, most well-known stock markets in the world. However, all across the globe, there are individual stock markets. The two in the United States that you may have heard of are called the New York Stock Exchange, or NYSE. The second major stock exchange is called the National Association of Securities Dealers, Automated Quotations, and we just abbreviate that to NASDAQ. That's what the NASDAQ is. So these two entities, the New York Stock Exchange and the NASDAQ, are places where investors and companies can meet to exchange money for shares in companies. Now, how about this term? What is the S&P 500? S&P 500. This is simply a collection of 500 of the largest and most profitable companies in the United States that are collected together, and those 500 companies are used to represent what happened in the stock market in general. For example, here is a typical day in the U.S. stock market. What you have here are 500 individual companies. And on any given day, some companies' stocks go up, while other companies' stocks go down. And the S&P 500 just simply takes all of those stocks, it averages them together, and then we report that number on the news. And by sharing that number, investors can get an idea for if the stock market in general went up that day or went down that day. So that's what the S&P 500 is. It's a representative slice of the stock market that investors can use to tell if the market went up or down. All right, so that's what a stock market is. Why do stocks have value? Why are they worth anything at all? Why are investors giving these companies money to get a share of their stock in exchange? Well, let's go back to our friend Apple. Apple has 15.8 billion shares of shares outstanding. Now, Apple, the company, owns some very valuable retail space. It has its huge corporate headquarters, for example. It has those retail stores all over the world. It has manufacturing facilities and research and development facilities. It has data centers. Those are assets that the company owns. In addition to that, Apple has over $100 billion in cash. That cash belongs to Apple, the company. And in addition, when you buy a share of Apple, you are buying a share of the company's future profits. So, when you are buying a share of a company, you are buying a portion of that company's assets, a portion of that company's cash, and a portion of that company's current and future profits. So all of those things are added together to give Apple, the company, a value. And then we take that value of Apple, the company, and we divide it by 15.8 billion shares. And that's why one share of Apple stock costs $152. So remember, with a stock, we're buying a legal claim, a piece of a company. That's what we're buying. And that company has assets that create value. Now, how do we figure out how much a share of Apple, or any company for that matter, is worth? Why is Apple's stock worth $152 per share, whereas Uber's stock is worth something different? Well, to help you understand this, let's go to the simplest business that exists, a lemonade stand. So I want you to pretend that I own a lemonade stand. Okay. And in my lemonade stand sells $10,000 worth of lemonade each year. Now, that lemonade stand has $9,000 of expenses. So in there is the lemons, the water, the facility, the labor, taxes, insurance, all that stuff costs $9,000 per year. So that leaves me with a profit of $1,000. So my lemonade stand generates $1,000 for profit for me every year. And this happens year in and year out. So 1 year to the next, $10,000 in sales, $1,000 in profit. All right, so now that we know this, let me ask you a question. How much would you pay me to buy my lemonade stand? How much would you pay for a business that generates $1,000 per year in profit consistently? Well, most people say, I have no clue. How do you value that? So let's throw out a number, okay? Let's say you told me, you offered me $1,000 to buy my lemonade stand, and I accepted, okay? So the price that you offered me was $1,000, and the profit that the business generates in 1 year is $1,000. So if we compare the price that you offered me to the annual profits of the business. That's called the price to earnings ratio. And in this case, the price to earnings ratio is 1. Now, is that a good price or a bad price? Well, let's think about the return on investment that you, the buyer, received. So you are now receiving a business that generates $1,000 in profit each year. And it only cost you $1,000 to buy it. That is a return on investment of 100% each year. That's kind of like finding a bank account that pays 100% interest. Well, that is an amazing deal for you, the buyer. But conversely, that's a horrible deal for me. So $1,000 is way too low. I, the seller, would never sell for $1,000. All right, let's say you offer me a different price. You're really interested in my lemonade stand, and you offer me $100,000 for the business. $100,000. Well, let's do that same analysis. So you have offered me a $100,000 price to buy the business. It still generates that $1,000 per year in profits. So that is a price to earnings ratio of 100. 100. Now let's calculate what the return on investment is for you, the buyer. Well, you're getting $1,000 per year in profit, but it cost you $100,000 to buy the business. That's a 1% return on your investment. Now, why would you, the buyer, accept a 1% return on investment when the current interest rate that you can earn in Mexico is over 10% per year? Why would you buy a business that you get a 1% return when interest rates are at 10% per year? So you wouldn't. So in other words, $100,000 purchase price is a great deal for me. I would love to sell you my business for $100,000. But that's a horrible deal for you, the buyer. That is way too expensive. So let's pretend that we both agree that a fair return on investment for you, the buyer, is 10% per year. 10% per year. Well, if the buyer wants a 10% return, the purchase price would be $10,000. So they buy it for $10,000. The annual profit is $1,000. That's a 10% return on investment for the buyer. Now, another way of saying 10 times a PE ratio of 10 or 10 times earnings is the price to earnings ratio was 10. So a 10% return, if we flip those numbers around, is a price to earnings ratio of 10. All right, so now we have a price for the business, $10,000. But let's add a slight wrinkle to the equation. Let's pretend that my business isn't static, isn't stable. It's growing. This is a growing business. So the first year profits start at $1,000, but they grow 20% each year. So instead of me doing $1,000 in profit, by year 2, we're doing $1,200. Then it grows 20% more to $1,400. Then it grows 20% more, and again, and again, and again. And this keeps happening. The business is becoming more profitable over time at a 20% rate. So with this in mind, if we assume that the price to earnings ratio of 10 is fair, how much will my lemonade stand be worth in 5 years? Well, to figure that out, we simply take the profits that the company is generating and we multiply it by that 10 price to earnings ratio that we just said was a fair price for the business. And if we do that math, we can figure out what the value of the business will be. So in year 5 years from now, after growing at 20% for 5 years, we can conclude that the value of my lemonade stand will be $20,700 because the profits of the business have grown to $2,000. So as profits grow, so does the value of the business. These two things are linked to each other. Profit growth equals value growth. Well, that same concept applies to publicly traded stocks. As when a company's profits grow, the business becomes more valuable and the investors that own that company's stock make more money. To show you this, let's talk about Apple. Rewind the clock to 2008. Back then, one share of Apple stock cost $6.20. And the company reported a profit of $6.5 billion. A huge number, but $6.5 billion. And back then, the iPhone was brand new. It was 6 months old. And the iPad, Apple TV, Apple Arcade, all of the Apple products that exist now, none of these existed. There was only the iPhone and it was brand new. So what do you think has happened to Apple's profits over the last 16 years after it introduced the iPhone? Well, let's look. Apple introduced the iPhone in 2008 and profits grew. And then it introduced the iPad in 2010 and profits grew. And then it introduced Apple TV, and then it introduced Apple Watch, and then it introduced Apple Pay and Apple Arcade. And all along this path, the company was launching in new geographies and offering different versions of its phone, and more customers were buying Apple products. So much so that the company's profit was $95 billion. $95 billion. It grew from $6 billion to $95 billion. So what happens when a company's profits go up? Its stock price goes up. Apple's stock price has gone up tremendously because its profits have gone up tremendously. And if you had the foresight to invest $1,000 into Apple in 2008, that would currently be worth $31,000. So Apple turned $1,000 into $31,000 today by growing its profits. And this same idea, growing profits leads to stock going up, applies to all kinds of companies. Here is Microsoft's profits. Notice the long-term trend. It started small and then has grown tremendously. So what do you think happened to Microsoft's stock price over this period? It went up substantially. How about Google? This is what happened to Google's profits over the last 18 years. So what happened to Google's stock? It went up. As a company's profits go up, its business becomes more valuable. And this same concept applies to the entire stock market, not just an individual stock, to the entire market. This concept applies. Here is a picture that shows the profitability of those 500 companies in the S&P 500 since 1960. Notice the long-term trend. The profits of the S&P 500 have gone up consistently. This is why the stock market has consistently gone up for 200 years. As business profits have gone up, the value of the companies collectively have gone up, which has driven the huge return that investors have got through investing in the stock market. So that's why the stock market goes up. But if you're like most people, you know that stocks are risky, that stocks can move up and down, and that you can lose money in the stock market. That's true. But let's talk about why that happens. The reason the stock market is volatile and fluctuates so often is because in the real world, that price to earnings ratio is not a constant figure. So remember back to our lemonade stand? Our lemonade stand became more profitable over time because the profits were going up. And since we had a price to earnings ratio of 10, the value of the business went up too. However, in the real world, the price to earnings ratio is not a fixed number. This is closer to what happens in the real world. Sometimes the price to earnings ratio expands. Sometimes the price to earnings ratio contracts severely. And this can cause the value of the business to swing up and down, even though the long-term direction of the business is up. The short-term direction of the value of the business is not predictable because the price to earnings ratio changing is causing the value of the business to fluctuate. Now, why does that? Now, here is the price to earnings ratio of the S&P 500 over the last 150 years. Look at how much this thing has fluctuated. Remember, this isn't the price, this is the price to earnings ratio. Why does this happen? Why are there some periods when the price to earnings ratio is going up and other periods where the price to earnings ratio is going down? Well, to understand this, let's go back to my lemonade stand. Let's go back to the simple, boring $1,000 per year profit of the lemonade stand. Now, we agreed that you would get a 10% return for buying my lemonade stand, which was a 10 PE ratio. So my lemonade stand was worth $10,000. However, right before you are going to buy my lemonade stand, some news comes out. The news is that Amazon is acquiring a lemonade company, and Amazon is going to make lemonade free for all of its Prime members. It's tens of millions of Amazon Prime members are going to get Dell's lemonade for free. Well, given this news, are you still willing to pay $10,000 to acquire my lemonade business? Well, if you're like most people, the answer would be no, of course not. I'm not going to get into a lemonade business where I'm competing with Amazon, where Amazon is giving lemonade away for free. So previously, before you signed my deal, you thought that this was a stable, reliable, predictable company. But because of this Amazon news, it's going to be impossible to tell if the company can continue to generate a profit. So you would be freaking out. You would be filled with fear. You, the potential investor, would be scared of investing in the business. You would now see this huge risk for buying this lemonade stand. So to compensate for that huge risk that you're taking by buying, you're going to now say, I don't want a 10% return. I want a 20% return. That's the only way that I'm going to invest in this business. I'm taking on the risk of competing against Amazon. I demand a higher return for buying the company. So let's say you demand a 20% return. Well, that shrinks the price to earnings ratio of the company from 10 all the way to 5. So instead of my business being worth $10,000, it's now worth $5,000. So the price to earnings ratio shrunk because the buyer and the seller are now filled with fear, and I am willing to sell this business much cheaper given this Amazon news. Okay, erase the Amazon news from your brain for a second. Now let's imagine another scenario. It's our $1,000 per year lemonade business. All that's the same. And then the government comes out with a new ruling. The government says that there can be no new lemonade stands. Lemonade stands are now outlawed. However, if you already have a lemonade stand, you can continue to run it. Well, would I, the seller, still want to sell you my lemonade stand for $10,000? Well, no way. Now, because of this government news, I am now guaranteed to not have any competition in the future. So my profits are not only far more likely to happen, but I can probably raise my prices. I'm probably going to get more business because the government has said that the competition for lemonade stands is going to go down. So I'm now feeling very excited. You, the buyer, are feeling very excited. So now, instead of me saying, I think this is worth 10 times its price to earnings ratio, I want to sell it at 20 times a price to earnings ratio. And you, the buyer, are okay with that. You're okay with accepting a 5% return because you think you can make the business more valuable in the future given this news. So if we now agree, because of this excitement, to a price to earnings ratio of 20, the value of my business doubled from 10,000 to 20,000 because of this news. Now, I want you to ask yourself this question about what we just talked about. What changed about the business? What changed about the business? The business was the lemonade stand the whole time. The lemonade stand was producing $1,000 in profits the whole time. Yet in one scenario, the value of the business got cut in half. And then in another scenario, the value of the business doubled. What actually changed in both scenarios? The answer is investor perception changed. The feeling of the buyer and the seller of the lemonade stands changed drastically. And that change in perception, one was driven by fear, another was driven by greed, cause the value of the business to swing wildly, even though the business remained the same in both cases. So when bad news comes along and investors are filled with fear about the future of potential of companies, the price to earnings ratio shrinks. But when investors are in a good mood and they're filled with greed, the price to earnings ratio expands. That's why this price to earnings ratio fluctuates. When investors are filled with fear, the price to earnings ratio declines sharply. When investors are filled with greed, the price to earnings ratio expands greatly. Now, this guy here, this guy's name is Benjamin Graham. He has a wonderful quote that sums up this phenomenon. If you don't know Benjamin Graham, he taught Warren Buffett, the best investor of all time. He was Warren Buffett's teacher. And he said, in the short term, the market is a voting machine. Votes matter depending on fear and greed. But in the long term, the market is a weighing machine. And again, that's Ben Graham. So what this means is in the short term, changes in investor perception drive everything. Prices go up and down based on fear and greed. But in the long term, it's the profitability of the companies that determine their value, their long-term value. All right, so now let's put some of these concepts together and ask ourselves, okay, so why does the stock market go up? Well, we've talked, stock prices move because of two factors. One, earnings, also called profits. And two, how investors feel about those profits, how investors value the profits that our company is generating. So as we've said, as I've shown, the profits of the stock S&P 500 go up over time. Why? Why do profits rise? What is the thing that causes this to happen? Well, by and large, there are a couple of phenomenon working in the background that cause profits to consistently rise. Thing number one is productivity. Humans get better each year at producing more output with less input. This is thanks to robotics, computerization, better manufacturing techniques. So more out for less in, that drives profits higher. Second, inflation. I don't need to tell you what inflation is, but when prices are rising, who's causing those prices to rise? Companies. So when prices go up, the profit that a company generates also goes up. Third, innovation. Overlooked innovation. When new products and new services come out that open up new revenue opportunities. So ask yourself this: what was the value of the smartphone market in 1995? Zero. There were no smartphones in 1995. What is the value of the smartphone market in 2024? It's worth a couple $100 billion per year. So the smartphone didn't exist. Then it came out and this huge market opened up that created tens of billions, hundreds of billions of dollars in value. That's innovation. A fourth, global expansion. It's a big world out there. There are billions of consumers around the world. And each year, companies work to expand to new geographies and open up their products and services to new consumers. And then finally, population. The total number of consumers in the world is increasing as the number of humans out there is increasing. So when you combine those factors together, innovation, productivity, inflation, population growth, and global expansion, those factors have combined to cause profits to consistently rise. And as long as those factors remain in place, it is logical to assume that this will continue to happen indefinitely. Profits will continue to rise from here. Now, that's why earnings will go up. We've already talked about how investors feel about those earnings and the price to earnings ratio of those companies, right? So sometimes the price to earnings ratio is going up. Sometimes the price to earnings ratio is going down. But over time, the price to earnings ratio smooths itself out. The highs become the lows become the highs, and this factor neutralizes itself. So why does the stock market go up? Now we have all the pieces we need to understand this. The stock market goes up because profits of companies, of the underlying companies, grow about 10% each year, and the price to earnings ratio of the market eventually reverts back to its mean. So when we are thinking about the long-term returns of the market, I'm going to show you a chart that I absolutely love. This shows what is the minimum, the maximum, and the minimum return that you have achieved by investing in the S&P 500 by holding period, by how long you became a shareholder for. And this is over 150 years. So the best 1-year return for investing in the S&P 500 was a 53% positive return. And the worst return in 1 year was negative 38%. But what happens if we hold for 2 years? Well, the best 2-year period return is 44% per year for each of those 2 years. The worst 2-year return was negative 28% per year for each of those 2 years. How about if we do 5 years? Well, the best 5-year return is a 23.5%, and the worst is a negative 13.5%. How about 10 years? Notice that the negative return that you earn is actually going down as you increase your holding period. So here's the 10-year return. Here's the 20-year return. If you've held the market for 20 years, you have never lost money. And these are in real terms. So this is after inflation. So the best return over a 20-year period was 13%. The worst return was about 0.7%. And then if you increase that out to 30 and 50 years, all of those gyrations, all of the short-term gyrations get neutralized, and you are guaranteed to earn the market's long-term return so long as you hold for a multi-decade period. So, one thing you need to internalize if you're an investor is that declines, short-term market declines, are normal. Perfectly normal. The market going down is normal. Over the last 100 years, the market falls about 10% about once every year. It falls about 20% about once every 4 years. It falls 30% about once a decade. And it falls 50% about 3 times per century. And if you look back at the last 200 plus years, there is always a smart sounding reason to sell. During this 60-year period right here, think of all of the things that went wrong in the world. There were wars. There was presidential assassinations. There was terrorist attacks. There was government deficits. There was countries going bankrupt, financial crises, terrible things. And yet during this period, the market went up 100-fold in value. So how can we deal with this? What should we do if we're an investor? How can we possibly deal with the gyrations? Well, the answer is to be like Aaron. Invest your money on a fixed schedule, no matter what is happening in the news. Aaron turned $19,000 into $300,000 because he consistently invested in the market no matter what was happening in the news. All right, I just threw a lot of information at you, so let's review, and then I think we'll have some time for Q&A. So, key takeaway number one, the U.S. stock market has delivered strong, consistent returns for over 220 years, and those returns outperform every other asset class. Takeaway number two, consistently investing in the market over a period of decades is the closest thing that exists to a magic wealth-building machine. Now, the U.S. stock market goes up because the business profits of those companies, the profits of the business in the S&P 500 go up. Now, why do profits go up? Profits go up because of productivity, because of inflation, because of innovation, global expansion, and the increasing population. And then finally, if in the short term, in a less than 5-year period, anything can happen in the market. The market can go up or the market can go down. But in the long term, when measured over 5, 10, or 20 years, the returns of the market are predictable because the returns of the market will match the profit growth of the underlying companies. Well, if you're interested in taking the next step, you're bought into the idea that investing in the market is a good idea, the good people at GBM will contact you with information on exactly how to do that. So thank you to them for sponsoring this talk. And I just want to say thank you so much for paying attention to this. I absolutely love teaching people this kind of information. And you can connect with me on any of these platforms, but looks like we have about 7 minutes left. So I'm going to read through some of the questions that you have. All right. Question number 1. What are your favorite books to learn about investing in the stock market? Well, my book is called Why Does the Stock Market Go Up? It is designed for complete beginners, people that know absolutely nothing about the market and just want to master the basics. I think that is a fantastic starting point. Beyond that, if you want to get a little more technical, this book here, which is called Stocks for the Long Run by Jeremy Siegel. This is a great read that has way more graphs, charts, and information in there than I could possibly put into my presentation. I'll also throw this book out there, which is called The Psychology of Money by my friend Morgan Housel. This is a great book on the psychology that happens when the way that humans deal with money. And then Let's see. These are mostly this one here, Millionaire Mission by my friend Brian Preston. This isn't about necessarily investing in the stock market, although they do cover it, but that's just a great general personal finance book. Here's a question. What sectors do you see as the most attractive for the coming year and why? So the question there is over the coming year. I love the stock market. I love investing, and I myself own 50-something stocks. I have no ability to predict which sector of the market is going to be the sector of the market over the next year. That's simply too short of a time period. If I was to guess, and boy, is this just a guess, just a guess, I would guess that the Magnificent Seven, the 7 biggest companies, Apple, Amazon, Microsoft, etc., will continue to be great places and good investments over the next year, but they eventually might lose their shine. But those companies are big and dominant, and I could see artificial intelligence adding to their competitive advantage and their lead as opposed to subtracting from it. But over the next year, truly anything can happen. What does he suggest to invest in? Index or a company in the short and long term? So indexing, buying into the S&P 500, I think generally speaking is a very good strategy for the vast majority of people out there. I myself invest in both index funds and individual stocks, but that's because I like to research individual stocks and I like to follow them and learn about them. So I have the interest in figuring out how to invest in individual stocks. Many other people don't. So to me, it's all about interest. If you're interested in investing in individual stocks, then you can invest in individual stocks. If you're not interested, there's nothing wrong with just investing in index funds. If you're a young investor, what's the recommended strategy? Picking stocks or broad market ETFs? Again, that totally depends on your interest level. To me, it's more about your personal interest in finding companies, researching them, following them, and owning them the right way, as opposed to just buying an ETF. If you're not interested in researching companies, no problem. Just buy broad-based index funds and call it a day. So to me, it's all about your own personal interest. What are the key indicators, such as price-to-earnings ratio, that we should look at when evaluating companies? So price-to-earnings ratio is one single metric. I would never make any investment based on one single metric. When I am investing personally, I take any company that I find through an investing checklist that I have developed. And I look at things like the financial statements, the competitive advantage, the long-term growth potential, the management team, the relationship between the company and its customers, the cyclicality of the business, the risks that I could see. And then from there, I then do valuation work to say, is the company trading at attractive value today or not? So there are actually lots of factors that I put a company through, and I have a checklist that I've shared online. If you go to my YouTube channel is called Brian. It's called Long-Term Mindset, but you can also type in my name. If you type in Brian Feroldi and then checklist, I have a video that explains my entire rationale. What common mistakes should beginner investors avoid when starting to invest in the stock market? And mistake number one, not educating yourself. To me, the first step to anything is to begin with education. Figure out what the stock market is. Understand why it works the way it does. Know and fully understand that the stock market will go down. And you have to understand the rationale for why the stock market goes down, and of equal importance, why the stock market will come back up. So I think the first step to any endeavor, especially one that involves money, is educate yourself. So focus. The final one will be Oh, so what other common mistakes are there? Well, the biggest mistake that I see is not investing. Just never investing in the first place. Not setting up systems to automatically invest. Not setting systems up to automatically build your wealth. It's never been easier. Never been easier. We are truly spoiled today to take advantage of the power of the stock market. It's actually very, very easy to do so. So that's the biggest mistake I see, is not getting started. Well, that brings us to the end of our time here. Just want to say thank you so much for choosing to spend an hour of your precious time with me. I hope this presentation was helpful, and I really hope that it helps to encourage you to take the next step and to start to research the stock market more, figure out how it works, and I believe starting to put some of your capital into the market so that you can start to build long-term wealth. Well, thank you all so much for your time and attention, and I'll sign off.